hoping the market will come back. In any case, the market invalidated their beliefs about the future, and they are suffering considerably. They had faith in 95 to 25, and in their minds the market betrayed them. If the market happens to come back to 95 to 25 after rallying for several days, how do you think the group of traders who sold at 95 to 25 the last time, the ones who believe they were betrayed, are going to behave? First, the traders who were hanging on in hopes of the market coming back will bail out as soon as they are close to being made whole. They are so grateful for getting their money back, there is no way they will stay in that trade regardless of what the possibilities are for additional profits. They will have to be buyers to liquidate their shorts and will be all too happy to end their suffering. The traders who originally cut their losses when the market blew through 95 to 25 won't consider selling at that price again because of the emotional pain of being wrong the last time they sold at that price. I am not saying they will in turn be buyers at that level, but they are very likely not to sell. The overall effect this will have on the balance of the market is to take away from the existing pool of available sellers at 95 to 25, old resistance, thereby causing the balance to be tipped in favor of the buyers. Hence, old resistance becomes support, and old support becomes resistance for the same reasons. Trends and trend lines. Trends, a series of higher highs and higher lows, or lower highs and lower lows over a period of time, work because there aren't enough sellers to absorb the number of buyers competing with each other to get into the market during that period of time. Adding to this buying force will be old sellers at lower levels who finally lose faith and bail out of their positions. They will do this in significant numbers when the prices penetrate what they believe to be significant reference points. Keep in mind that trends are a function of time. The next tick up could be defined as a one-tick trend. How long will the imbalance between buyers and sellers last? In an upward trending market, prices will retrace because buyers are taking profits. This will create some counteracting pressure, but if the trend continues after a normal retracement, it just tells you there still aren't enough sellers around to absorb all the buyers, with enough left over to create downward momentum. You will know when that has happened when the trending market breaks its normal ebb and flow pattern. That is why markets that break trend lines have a tendency to keep on going in the direction of the break, because it signals a significant shift in the balance of forces. After a certain period of time, you can notice how trending markets will develop a certain rhythm and flow, making the price movement look very symmetrical on a bar chart. You really don't have to know why this is so. You just have to notice that it exists. When this flow is broken, the market trading above or below a significant trend line, it is a good indication the balance of the market forces has shifted. Then ask yourself, what is the likelihood the shift will gain hold and continue trending in the direction of the break? You don't even have to know the answer to that question. Put in an order at a spot that would confirm the highest probability of a change in the balance. Then wait for the market to define itself. If your order is filled, put a stop where the market shouldn't be to confirm that your trade is still valid. What is a valid trade, you ask? One where the highest probabilities for price movement are in the direction of the prevailing force. High retrace rally to a lower high. I will give you an example. No matter how simple a trade this is, it has very sound psychological reasons for working. In this example, the market made new highs and sold off. The sell-off could be the result of new sellers cornering into the market in force, or old buyers selling to take their profits, or a combination of both. Prices will continue to drop until enough traders believe the price is cheap and are willing to take the initiative and bid the price back up. As the price approaches the last previous high, buyers will begin to anticipate whether or not prices can penetrate, and sellers will be looking for another top. In either case, expectations by both will be raised. If some buyers are willing to bid the price past the previous highs to some significant level, it will make believers out of others who are on the sidelines. If they do come in, it will add to the momentum. Some old sellers will admit to being wrong and will have to buy to get out of their trades, thus adding to the upward momentum. However, what if the market approaches the highs the second time, and sellers come back into the market again with enough force to keep the price from exceeding or equaling the previous high? Buyers will start to become disappointed. Where will they really be disappointed? If enough buyers don't come into the market to support the price at the previous low. If prices penetrate that low, watch for buyers to bail out en masse. For them to get out of their position, who is going to buy it from them? If everybody is trying to sell and no one is available to buy, what are prices going to do? Fall like a rock. The reason why a bull market is ready to turn into a bear market when the general public gets involved is because the general public has the least tolerance for risk and consequently needs the most reassurance and confirmation that what they are doing is a sure thing. As a result, they will be the last to be convinced that the rising market represents an opportunity. If a bull market has lasted for any length of time, the general public will feel compelled to jump on the bandwagon, so to speak, because of their perception that everyone else is doing it and making money. They will pick up on any reason that sounds the most rational to justify their participation, when in reality, they will know very little about what they are doing. But since everyone else is doing it, how can they go wrong? A continuing bull market requires the continual infusion of new traders who are willing to pay higher and higher prices. The longer a bull market lasts, the greater the number of people who are already participating as buyers, leaving fewer and fewer traders who haven't already bought and fewer traders who are willing to bid the price up. These older buyers obviously want to see the market keep on going up, but they also don't want to get caught holding the bag if the market stops going up. As their profits accumulate from the higher prices, they start to get nervous about taking their profits. By the time the general public starts buying en masse, the professional traders knows the end is near. How does the professional know this? Because the professional knows that there is a practical limit to the number of people who will participate to bid the price up. There will come a point where everyone who is likely to be a buyer will have already bought, quite literally leaving no one else to buy. The professional trader would like the market to continue to go up indefinitely, just like all the other buyers. However, he also understands the impracticality of that happening, so he starts taking his profits while there are still some buyers available to sell to. When the last buyer has bought, the market has no place to go but down. The public gets stuck because they weren't willing to take the risk when there was still potential for the market to move. For the market to sustain itself, it needs to attract more and more people. As big as this country is, or the world for that matter, there are only so many people who will buy. Eventually the supply of buyers runs out, and when it does, the market falls like a rock. The professionals have been selling out their positions before this happens, but once the supply of buyers runs out, the professionals start to compete among one another for the available supply of buyers, which is dwindling fast, so they offer lower and lower prices to attract someone into the market so they can get out. At some point, instead of the lower prices being attractive to people, it panics them. The public didn't anticipate losing. Their expectations are very high with very little toleration for disappointment. The only reason they got in was because it was a sure thing. When the public starts to sell, it starts a stampede. Again, people will ascribe their actions to some rational reason because nobody wants to be thought of as irrational and panic-stricken. The real reason why people panicked and the prices fell is simply because prices didn't keep on going up. Chapter 16. The Steps to Success. Self-discipline is simply a mental technique to stay focused on what you need to learn, or do, to accomplish your goals. There will be times when you won't have the resources to function effectively relative to the external conditions. Other times the resources you do have will be in conflict with both the conditions and your goals. So to accomplish your goals, you will need to adapt. In other words, you will need to change the way you interact with the environment. To change your behavior and how you experience the environment, feelings and emotions, you will have to change your perspective. To change your perspective, you will have to change the mental components that affect your perception of environmental information. Keep in mind that you can't physically control what the markets do. You can only learn to control your perception of the markets to share the highest degree of reality, the least amount of distortion, with everyone else who is participating or has the potential to participate. The more sophisticated you become as a trader, the more you will realize that trading is completely mental. It isn't you against the markets, it's just you. All the other traders participating to make the market provide you with an opportunity to make money from their divergent beliefs about the future. If people didn't disagree about the future value of any particular commodity or stock, then there would be nothing to compel them to either bid a price higher or offer it lower, and the opportunity to profit from these changes would cease to exist. So the markets just offer the individual trader opportunity. They don't choose the data on which you focus your attention, and they certainly don't interpret the data you perceive. Nor are the markets responsible for what you can't perceive because of the distinctions you haven't learned to make yet. They also don't choose when you put on a trade, how long you stay in, when you get out, or how many contracts you buy or sell. Each individual trader creates his own experience of the markets based on this picking and choosing process and the decisions that result. If you accept this concept as valid, then the implications are that you will never have a valid reason to blame the markets for your unsatisfying results. The markets don't owe you anything, regardless of how hard you work to be successful, because every other trader participating is doing so to take your money away. You and you alone are completely responsible for whatever you end up with. The sooner you accept that responsibility, if you haven't already, the easier it will be to identify what skills you need to learn to interact with the markets more successfully. Even if you can't identify the mental components responsible for what you ended up with, at least by assuming that you are responsible, you will be opening yourself up to find out. To be a successful trader, you need to trade without fear. As you have already learned, when you use fear as a resource to limit yourself, you will create the very conditions you are trying to avoid. Or to say this another way, you will experience your fears. You also can't learn anything new because fear will force you to perceive the environmental now from your individual past. You will experience that past regardless of the opportunities the environment may have to offer in that same moment. Your individual history will repeat itself until you change your history, which will then allow you to learn and experience something new. Evolving beyond your fears is also the best way to learn how to predict market behavior. The more fearful traders are, the fewer the choices they perceive as available to themselves, and the easier it is to predict their behavior. You will be able to recognize this clearly in others when you recognize it yourself and work your way out of the condition where you trade with fear. However, you will need some resource to limit yourself so that you don't get reckless. Getting reckless is exactly what people have a tendency to do if they don't feel any fear, especially if there is a potential for thrilling results, as there is in trading. The resource you need to limit yourself is self-trust. You will gain that self-trust when you establish a set of rules and guidelines to trade by and know that you will always follow those rules without hesitation, regardless of the temptations to do otherwise. Once you trust yourself to always do what needs to be done, there will be nothing to fear because the markets won't be able to do anything to you, as a result of your inability to respond appropriately. Consequently, with nothing to fear, you are then free to observe the markets free of distortions. There won't be any need to avoid certain categories of information because of how that information will make you feel. The less reason you have to avoid or distort information, the more you make yourself available to learn about the nature of the markets. The more you learn, the easier it will be to anticipate what the market will do next. If you can accurately anticipate what will happen next, the easier it will be to give yourself more and more money, notwithstanding any mental components that would argue against giving yourself more money. It is very important for you to understand that these new insights about the market's behavior will come in stages as you learn to trust yourself more and more. There is no get-rich-quick scheme being offered here. There are enough rags to riches stories to attest to the fact that get-rich-quick doesn't work anyway. Getting rich quick can only lead to a great deal of anxiety and frustration if you don't have the skills to keep it. There isn't much point to making a lot of money if you are as susceptible to making that one trading error that can give it all back plus more. Once you have made a fortune and lost it, the psychological work that you will need to do to get it back is enormous compared to work that is necessary to keep yourself from losing it in the first place. As a trader, it is more important to know that you will always follow your rules than it is to make money, because whatever money you make, you will inevitably lose back to the market if you can't follow your rules. You also need to understand that your rules will change as your understanding and insights evolve. Many people don't like to establish trading rules because they believe that once made, they can't be changed. Any exercise that I offer you or rule that you select to guide your trading behavior is only transitory. They are methods and techniques to get you beyond certain fundamental stages of development so that you can recognize for yourself their value and what you need to do next to be more successful. In fact, a good rule of thumb to use to determine your readiness to move beyond a certain rule or exercise and to the next challenge is the recognition that you can do what you set out to learn so well that it becomes second nature. Otherwise, keep working at it until you don't have to think about it any longer. Step 1. Staying focused on what you need to learn. First and foremost, you may need to change your perspective or the focus of your trading. Until now, your focus may have been to make money. If this is so, you will need to change your perspective to what do I need to learn or how will I have to adapt myself to interact more successfully? You need to stay focused on mastering the steps to achieving your goal and not the end result, knowing that the end result, money, will be a byproduct of what you know and how well you can act on what you know. There is a tremendous difference between focusing on money and focusing on using your trading as an exercise to identify what you need to learn. The first will cause you to focus on what the markets are giving you, or are taking away from you. The second perspective causes you to focus your attention on your ability to give yourself money. With the first perspective, you are placing some of the responsibility onto the markets to do something for you. With the second perspective, you assume all the responsibility. Always keep in mind that each moment is a perfect reflection of your level of development. If you look at each moment that things don't turn out as you want or expect as a mistake, then you will usually cut yourself off from the insight about yourself contained within each moment. The reason why we will cut ourselves off from this information is because we typically associate mistakes with pain. We will instinctively avoid pain and in doing so also avoid what we need to know about ourselves to interact more effectively in similar circumstances in the future. To evolve beyond pain and our fear of mistakes, our mistakes have to be resolved. This could be a big task and you may not want to tackle it at this time. So what you will need to do is build a corollary framework to place all of your trading experiences. This framework needs to be defined in such a way that all experiences are valid and have meaning, and, as such, mistakes don't exist, they just point the way. As part of this framework, you may also need to change your definition of a missed opportunity. Except for the inability to accept a loss, there isn't anything that has the potential to cause more psychological damage than a belief in missed opportunities. Missed opportunities are trades that would have always turned out perfectly because they only occurred in our minds, where we can make anything be as we want it to be. Of course, we would have responded exactly as the conditions warranted without flaw. The problem is we didn't do it, and the resulting sense of loss we feel is difficult to reconcile. Therefore, these missed opportunity trades have the potential to cause more anxiety and stress than the trades we actually do take that turn out to be losers. Nothing's worse than missing a perfect opportunity. However, if you could have, you would have. It's that simple. The sooner you accept this, the sooner you will be able to take advantage of these missed opportunities instead of beating yourself up over them. Besides, there really isn't anything to miss because the markets are in perpetual motion and will continue to be until everyone agrees on value. As long as the price keeps changing, there will always be another opportunity. When you start trading from the perspective that mistakes don't exist, you will be amazed at the sense of freedom you will feel to grow by accepting your results as a reflection of who you are in that moment, which then allows you to determine what you need to learn to do better. When you release the energy out of the belief that it is possible to miss anything, you will no longer feel compelled to do something, like getting into trades too early or too late. In other words, you will be giving yourself additional choices. Not doing something is often the most appropriate choice, where only one choice existed. You need to constantly keep in mind that the professional traders from whom you are trying to extract money already know and are using many of the principles put forth in this book. They understand the concept of objectivity, have learned how to trade without fear, and know how to execute their trades properly. Before you can begin to take money out of the markets consistently instead of the markets taking yours, you will also have to learn these skills. So, I would suggest that you set aside a certain amount of trading capital as tuition for your education. How much you set aside will be a function of how many skills you need to learn. What is most important is that you make a firm commitment to your education as a trader. Even if you have been trading for years and you are successful, but not as successful as you would like to be, setting aside money that you will trade with as an exercise to learn some needed skill is a very powerful symbol of your commitment to learning that skill. The stronger your commitment, the faster you will learn. Step 2. Dealing with losses. Trading Rule 1. Predefine what a loss is in every potential trade. By predefine, I mean determine what the market has to look like or do, to tell you that the trade no longer represents an opportunity, at least not an opportunity in the time frame in which you trade. When your beliefs about losses are restructured, the possibility of a losing trade will not create any threat of pain. Most successful traders restructured their beliefs about losses after they lost one or more fortunes. They experienced their worst fears about losing and then came to the realization that they didn't have anything to fear if they just did what needs to be done. What needs to be done? Confront the possibility of being wrong and consequently not avoid the inevitability of taking a loss. So confronting and accepting the inevitability of a loss is a trading skill. Certainly a skill learned the hard way for most, but nevertheless an essential component at the foundation of virtually everything you need to learn to become a successful trader. The relatively few successful traders in the market today did it the hard way. You, on the other hand, have the opportunity to do it much more easily. There will be two mental components at work to help you acquire this skill. First is your understanding of why it is so essential to confront the possibility of a loss. If you don't, you will generate fear and end up creating the very experience that you are trying to avoid. When you really understand this concept, it will become unacceptable to you to trade from the old perspective of loss avoidance. The second is your willingness to change your definitions of what it means to lose. By using some of the mental exercises in Chapter 14, you can change these definitions by using your thoughts instead of having to lose everything or practically everything you own to get to the same place. That place's losses do not diminish me, you, as a person. The sooner you believe it, the easier it will be to identify and execute a losing trade. By making the execution of a losing trade an automatic function of your trading strategy, you make yourself psychologically available to take advantage of the next opportunity, even if that opportunity is in the same direction of the losing trade you just got out of. Trading Rule 2. Execute your losing trades immediately upon perception that they exist. When losses are predefined and executed without hesitation, there is nothing to consider, weigh, or judge and consequently nothing to tempt yourself with. there will be no threat of allowing yourself the possibility of ultimate disaster. If you find yourself considering, weighing, or judging, then you are either not predefining what a loss is or you are not executing them immediately upon perception, in which case, if you don't and it turns out to be profitable, you are reinforcing an inappropriate behavior that will inevitably lead to disaster. Or if you don't and the loss worsens, you will create a negative cycle of pain, that once started will be difficult to stop. The next error after letting a loss get out of hand is usually not taking the next opportunity, which invariably is always a winning trade. After which, we get so angry at ourselves for passing up that opportunity that we make ourselves susceptible to any number of other trading errors, like taking a trade that was a tip from another trader, which invariably is always a loser. It is important for you to note that once you completely trust yourself to cut your losses, you will eventually get to the point where you may not have to predefine what a loss is. There are traders who have reached such a high degree of objectivity and trust that they can get into a trade and know when it is a loser without having to predefine it for themselves. They let the market define it for them based on their comprehensive knowledge of the various participants involved and their knowledge of the various relationships between price movement and time. However, the reason why they were able to learn what they know about the nature of the markets is because their focus of attention widened to include more undistorted information, leading to greater insights. Once they learned, first, however, to trust themselves. Keep in mind, that fear is really the only thing that keeps us from learning anything new. You can't learn anything new about the nature of the market's behavior if you are afraid of what you may do or can't do that is not in your best interests. By predefining and cutting your losses short, you are making yourself available to learn the best possible way to let your profits grow. Step 3. Becoming an expert at just one market behavior. Generally, most of us grow up believing that when we have to make a decision, the more relevant information we can gather, the better our decisions will be. This isn't necessarily true with trading, especially in the beginning stages of one's career. In most market situations, there is an even number of traders who have a propensity to buy and those who have a propensity to sell, or those who need to buy and want someone to take the other side of the transaction, and vice versa. Everyone will have his reasons and rationalizations for all this trading activity, creating about as much conflicting information as there are participants. Because there is so much information and because so much of that information is conflicting, the beginning trader will need specifically to limit his awareness of the market information to which he allows himself to be exposed. More is not better. It just creates confusion and overload that will ultimately lead to losses. You need to start as small as possible and then gradually allow yourself to grow into greater and greater amounts of market information. What you want to do is become an expert at just one particular type of behavior pattern that repeats itself with some degree of frequency. To become an expert, choose one simple trading system that identifies a pattern, preferably one that is mechanical, instead of mathematical, so that you will be working with the visual representation of market behavior. Your objective is to understand completely every aspect of the system, all the relationships between the components, and its potential to produce profitable trades. In the meantime, it is important to avoid all other possibilities and information. Out of all the combinations of behavior possible, you are going to limit your focus of attention to just one combination. Consequently, you will be letting all the other opportunities go by. Starting small and gradually working into other combinations is a real exercise in discipline that has a couple of important psychological benefits. First, you will be building a base of confidence as you learn that you can, in fact, accurately assess what will most likely happen next. It is much easier to gain this confidence if you don't overwhelm yourself with the market's seemingly infinite possibilities. Second, by passing up other opportunities that you are not an expert at yet, you will be releasing yourself from any compelling desire to trade. Any compelling behavior is usually the result of some fear. That fear, in turn, will cause you to behave in many inappropriate ways. If the idea of letting go of opportunities that don't fit into your framework is troubling to you, then ask yourself, what is the rush? If you are confident in your ability to transform yourself into a successful trader, what difference could it make that you let go of some opportunities now for educational purposes? Once you learn to become the trader you want to be, you can then give yourself as much money as you desire. However, to get to that point, your objective should be to plan your development in such a way that you do the least amount of damage to yourself, both financially and psychologically. Then after you have developed the appropriate skills, taking money out of the markets can be as easy as almost everyone believes it is before you started trading. If, on the other hand, you end up doing a lot of damage to yourself, you will have to undo that damage before you can accumulate wealth as a trader. After the damage is done, it won't make any difference how much you learn about the nature of the markets or how well you learn to perceive an opportunity. There are many traders who end up becoming expert market analysts but can't make a dime as traders because of all the damage they did to themselves in the early part of their trading careers. What happens in these situations is a trader's past will generate so much fear that he won't be able to execute his trades properly or not at all, regardless of how well he learned to predict what the market will do next. Nothing is more frustrating than to know what is going to happen next and not be able to do anything about it. You need to understand that the ability to perceive an opportunity, based on the quality of distinctions that you can make and your ability to execute a trade, are not automatic functions of one another. Perception and execution are separate skills. They can and do work in tandem, if there are no mental components blocking execution. Otherwise, the intent to take advantage of what you perceive as an opportunity may not have any inner support or the kind of inner support that is necessary to execute your intent properly. If there are mental obstacles preventing the proper execution of a trade, then learning how to perceive better opportunities is not going to solve the problem. So the object of this exercise is to help you learn how to become an expert and stay healthy while you are doing it. And when you do become one, there will be much less standing in the way of your taking maximum advantage of your perceptive skills. If you are already looking at or trading several markets and you are not successful or not as successful as you desire, then I would suggest that you scale back to just one market or two at the most. Don't expand until you thoroughly understand the market's characteristics. Step 4. Learning how to execute a trading system flawlessly. The proper execution of your trades is one of the most fundamental components of becoming a successful trader and probably the most difficult to learn. It is certainly much easier to identify something in the market that represents an opportunity than it is to act upon it. However, there are some good reasons why it is so difficult to act on a trading signal other than what has already been identified as mental obstacles. To understand these reasons, you need to understand the nature of trading systems, defined as any methodology that consistently identifies an opportunity to buy or sell with a potential profit in some future moment, and how they interact with the markets and ourselves. Most good trading systems, technical or otherwise, will take consistent money out of the markets over the long run. Many of these good systems have been available to the public for years, and yet, there is still a huge gap between what is possible and what almost everyone ends up with. The problem with trading systems is they define market behavior in limited ways when the market can behave in an infinite combination of ways. Systems mathematically or mechanically reduce relationships in human behavior characteristics to percentage odds of what could happen next. They can only capture a very limited number of these behavior characteristics compared to the billions that are possible. Any identified pattern may or may not be repeating itself with respect to the way the pattern or relationship progressed when it was observed in the past. Therefore, we never really know if it is valid or not until it has actually completed itself. The big psychological problem here is that people have difficulty acting on opportunities with probable outcomes. Most people like to think of themselves as risk takers, but what they really want is a guaranteed outcome with some momentary suspense to make them feel as if the outcome had been in doubt. The momentary suspense adds the thrill factor necessary to keep our lives from getting too boring. When it comes right down to it, no one trades to lose, no one puts on a trade believing it is going to be a loser, and all systems will definitely have some percentage of losing trades. So it's difficult not to be tempted into trying to guess which ones are going to be the losers and not participate. As most of you reading this book already know, trying to outguess your trading system is an exercise in extreme frustration. Sometimes the system will give you signals to trade in ways that are completely contrary to your logic and reasoning. Sometimes the system will defy your reasoning and be right, and sometimes you will agree with the system and it will be wrong. You need to understand that technical trading systems are not designed to be outguessed. What I mean is, they aren't designed to give you isolated signals of an opportunity to be taken when it seems right. What they do is mathematically define, quantify, and categorize past relationships in collective human behavior to give you a statistically probable outcome of the future. As a comparison to trading, it is much easier to take risks and participate in a gambling event with a purely random outcome based on statistical probabilities, simply because it is random. What I mean is, if you risk your money on a gambling event that you know has a random outcome, then there's no rational way you could have predicted what that outcome would be. Therefore, you don't have to take responsibility for the outcome if it isn't positive. Whereas, with trading, the future is not random. Price movement, opportunity, and outcomes are created by traders acting on their beliefs and expectations of the future. Every trader contributes to the outcome of the future by putting on and taking off trades in accordance with their beliefs. Because traders actually create the future by collectively acting on their beliefs about the future, the outcome of their actions is not exactly random. Why else would traders try to outguess their systems, unless they had some concept of the future and how that future will affect the markets? This adds an element of responsibility to trading that doesn't exist with a purely random event and that is difficult to avoid. This higher degree of responsibility means that more of your self-esteem is at stake, making it much more difficult to participate. Trading gives you all kinds of ways to beat yourself up for all of the things you should have or could have considered that would have resulted in a more satisfying outcome. Furthermore, you don't trade in an information vacuum. You form your expectations about the future with information technical systems don't take into consideration. Consequently, this sets up a conflict between what your intellect says should be happening and the purely mathematical means of predicting human behavior afforded by your technical system. This is precisely why technical systems are so difficult to relate to and execute. People aren't taught to think in terms of probabilities, and we certainly don't grow up constructing a conceptual framework that correlates a prediction of mass human behavior and statistical odds by means of a mathematical formula. To be able to execute your trading systems properly, you will need to incorporate two concepts into your mental framework: thinking in terms of probabilities and correlating the numbers or the mechanics of your system to the behavior. Unfortunately, the only way you can really learn these things is actually to experience them by executing your system. The problem is that rarely will the typical trader stay with his system beyond 2 or 3 losses in a row, and taking 2 or 3 losses in a row is a very common occurrence for most trading systems. This creates something of a paradox or catch-22. How do you do it if you don't believe it? And you won't learn to believe it unless you do it long enough for it to become a part of your mental framework. This is where you employ mental discipline to make flawless execution a habit. Exercise. Take some of the trading capital that you set aside for your education to buy and trade a simple trading system with well-defined entry and exit points. Make a commitment to trade this system exactly according to the rules. You need to make a very strong commitment here and not play any games with yourself. The object of this exercise is to work through any resistance you may have to following your rules. This system does not have to be expensive. You can get one out of many of the books on technical analysis available today. I think it is important to buy one instead of devising one of your own because it might be a little easier to stay focused on the objectives of this exercise. With any system you devise, you are naturally going to want to make money. Save it for later, after you have learned how to execute properly. You also need to find a system that suits your unique tolerance for taking a loss. The amount of money you risk per trade should be an amount that you are completely comfortable with, at least at first. If you don't stay within this tolerance level, you will be, at the very least, uncomfortable, in which case to whatever degree you are uncomfortable, you shut down the learning process. When you are feeling pain, instead of being focused on what the market is teaching you about itself and yourself, you will be focused on information that will ease your pain, which usually results in a painful lesson. Your objectives are to 1. Learn the skill of flawless execution by learning that you can follow the rules you set forth for yourself. I am defining flawless execution as executing a trade immediately upon perception of an opportunity. Inclusive within opportunity is the opportunity to exit a losing trade, and 2. To incorporate a belief into your mental system about the nature of probable outcomes so that you believe that you can make money in the long run with your trading system, if, of course, you can execute it properly. You will likely encounter many beliefs arguing against flawless execution. Here are a few suggestions to help you work through this resistance. First, understand that this exercise, at least for most people, is not going to be easy, so be easy on yourself. The more accepting you are of your mistakes, the easier it will be to make the next attempt. If your child were learning how to ride a bike, I'm sure you wouldn't scold him for falling off and tell him not to try again. You would encourage him and eventually he'd learn. Give yourself the same kind of understanding and consideration. Second, taking all the signals generated by your system is the only way you can get the first-hand experience you need to establish a belief in probable outcomes, and relating the mathematics or the mechanics to the behavior. You have to do it in spite of your resistance, and you have to do it long enough for the system to become a part of your mental framework. When that happens, you will have the force of habit working for you, and the struggle will cease. Just do the best you can and look for ways to improve your performance. Constantly keep in mind that what you are doing is more of an exercise in learning trading discipline and the skill of flawless execution, which in the long run is far more important than your immediate desire to make money. So keep your contract size light. You can always increase it later, when you have learned to trust yourself completely to always do what needs to be done without hesitation. Stay with the exercise until it becomes second nature or a part of who you are. As you gain in your confidence, you will learn more and consequently learn how to make money as a trader. As you make money, you will gain in your confidence. This positive cycle will expand your ability to be successful just as easily as a negative cycle will feed on itself to end in despair. Step 5. Learning to think in probabilities. After you have mastered the more fundamental skills, in other words, once you have acquired the discipline necessary to interact with the trading environment effectively, you can start to use your reasoning skills and intuitive powers to determine what the market is likely to do next. This will entail learning to think in probabilities. What I mean by this is, if you can't personally move the market, then you will want to be able to identify the group that is demonstrating the greatest possibility of moving the market, and you will want to trade with that group. Or you will want to determine the prevalent beliefs being expressed in the market and how those beliefs will affect price movement. That identification process requires a detached objective perspective, where you are watching and listening to what the market is telling you, instead of being focused on what the market is doing to you personally. Remember, two traders willing to trade at a price make a market. Whatever the extreme ends of human expression are is what the market is capable of doing. For example, have you ever said, the market can't break contract lows, it's never been there before? If you bought those lows based on your belief of its impossibility, then consider that all it takes is one trader who is willing to sell lower to make you wrong. The fact that the market did it makes it right. You could have been a seller at the all-time lows and been a one-tick winner when the next trader broke those lows, if you could have perceived selling as an opportunity. If prices were to penetrate those lows with any kind of follow-through, it would indicate that there are plenty of traders who believe it wasn't going higher. These sellers obviously acted on their beliefs with enough force to outnumber the buyers available to take the other side of the trade. Regardless of the criteria the sellers used to justify their actions, how rational or irrational by anyone else's standards, nothing will alter the fact the market traded lower. The fact that you believed it couldn't do it is of no consequence, unless you can trade big enough numbers to reverse it. Otherwise, you can either be with it or against it. To help you learn how to be with the flow of the market, I pose a series of questions that are designed to keep you focused in the now moment to determine what is true about the market. 1. What is the market telling me at this moment? 2. Who is paying up to get in or get out? 3. How much strength is there? 4. Is momentum building? 5. Can it be measured relative to something? 6. What would have to happen to indicate the momentum is changing? 7. Is the trend weakening or is this a normal retracement? 8. What would show that? If the market has displayed a fairly symmetrical type of pattern and that pattern has been disturbed, then it is a good indication the balance of forces has shifted. 9. Are there any places where one side will definitely gain dominance over the other? If that point is reached, it still may take some time for the other side to be convinced they are losers. How long are you willing to give them to stampede out of their positions? 10. If they don't stampede out of their positions, what will that tell you? 11. What did traders have to believe to form the current pattern relative to the past? Remember that people's beliefs don't change easily unless they are extremely disappointed. People are disappointed when their expectations aren't fulfilled. 12. What will disappoint the predominant force? 13. What is the likelihood of that happening? 14. What is the risk of finding out on a trade? 15. Is there enough potential for movement to make the trade worth the risk? We may never know what traders will in fact do, but we can determine what they will likely do if certain things happen first. For example, if traders push the price lower than the previous low, what will likely occur? Is this new low significant enough to cause traders holding long positions to bail out? Will it cause new shorts to enter the market or attract existing shorts to add to their positions? New shorts may be attracted to the market, and old shorts will add to their position. This price slide will stop when enough traders believe the price is cheap relative to something. That reference point will likely be some other previous old high or low. If you can't determine the significance of any particular high or low or any other significant reference point for that matter, then you have to ask yourself if it is worth the risk of finding out how much room will you have to give the market to define itself before it is evident that the flow of the market is not in the direction of that trade. Ask yourself this question: for this trade to be valid or continue to be valid, the market shouldn't trade to what point? If it trades within that point, then the trade still has potential for working. Beyond that point, it is no longer valid in the direction that I started. Keep in mind that the amount of price movement that you determine is necessary for the market to define itself has to correspond with your emotional tolerance to accept the dollar value of a loss that size. Otherwise, don't take the trade regardless of how much potential you think it might have, unless you can realistically change the foregoing parameters to fit your capacity for a potential loss. Let the market define itself and then apply whatever criteria you use to define an opportunity. Identify your significant reference points and place your orders on either side of the point, then wait for the market to do whatever it is going to do. Try putting your orders in the market in advance of whatever you perceive as having a high probability of occurring based on the existing market conditions. By putting your orders in advance of some anticipated move, you will be learning how to let the market work for you. Placing your orders in advance will also help to keep you from having an opinion, and you won't be subjecting yourself to the moment-to-moment conflict inherent within all price movement. Keep in mind that since the market is in perpetual motion, it puts you in a position of having to make never-ending assessments of the current risk in relationship to the current possibilities for reward. To do this effectively, you will have to learn to observe the market as if you were not in a position. This perspective will free you to take whatever action is appropriate for the situation instead of hesitating, hoping, and wishing that the market will make you right. The market doesn't make you right, you make yourself right. Your inability to execute or the degree to which you hesitate after you perceive an opportunity to get in or out of a trade or reverse your position will be an excellent gauge as to how locked in you are mentally. Making note of these occurrences of hesitation or immobility will give you an indication of the exact state of your mental resources to execute. You need this information to use as a reference point to build from. When you are about to enter into a position, ask yourself, by imagining, what the next 5 minutes or tomorrow, depending on your time frame, would have to look like to validate your trade, to confirm that the trend is still intact. What would the next 5 minutes or tomorrow have to look like to indicate? Ask yourself, by imagining, what the next 5 minutes or tomorrow, depending on your time frame, would have to look like to validate your trade, to confirm that the trend is still intact. What would the next 5 minutes or tomorrow have to look like to indicate the opposite? Then, again, place your orders at the appropriate price in advance of the markets getting there. All these questions will keep reminding you that anything can happen, and you will be preparing yourself in advance for those possibilities. Also, if anything can happen, then of course, you will have to consider that there will always be something you haven't taken into consideration, had absolutely no awareness of or could have no prior knowledge of, for example, such as how many traders may enter the market for the first time with enough force to reverse its direction. Keep in mind that prices move in the direction of the greatest force, traders fulfilling their beliefs about the future. Or said in its converse form, prices will move in the direction of the least resistance to the prevailing force. Significant reference points give you the opportunity to make high probability assessments of the degree of balance or imbalance between the two forces, the point at which it is likely to shift, and in whose favor. By learning to identify significant reference points, you can determine what each group will do based on what they already believe about future value. If you can determine on a collective basis what will validate or invalidate those beliefs, then you will know how each group is likely to behave. I want to remind you that this approach is to help you stay detached and understand that price movement is a function of traders acting individually and collectively as a force expressing their beliefs in future value. The greatest number with the strongest belief will always be right. The easiest way to make money is to go with the flow. To identify the flow, you need to stand apart from the crowd and suspend what you believe about relative value so that you can determine who is likely to do what and with how much force. How is everyone else likely to react? And if it doesn't happen, what will traders do then? By asking yourself these questions, you are automatically keeping your focus of attention on the market and what the possibilities are. Any limitations you place on the market's behavior will cause you to focus on the impossibility instead of the possibility of something happening. Your belief that the market has to behave in certain ways proscribed by your mental structure will cause you to focus your attention on what the market is doing to you. And if what it is doing is causing pain, then the potential exists for you to avoid or distort information, usually resulting in a painful forced awareness. Step 6. Learning to be objective. To achieve a state of objectivity, you need to operate out of beliefs that allow for anything to happen, as opposed to beliefs that allow only for the market to express itself in a limited fashion. If you operate out of a belief that anything can happen, then whatever does happen won't be threatening to you in any way, thereby causing you to avoid or distort certain categories of market information. Any limits you place on the market's behavior will be a compensating factor for your lack of trust and confidence to act appropriately in any given situation. This will be evidenced by the fear, stress, and anxiety that you will feel when the market expresses itself beyond your mental limits and you can't do anything to control the situation. However, you do have to have some belief or expectation about the future, or you would never put on a trade in the first place. To be objective, you will need to release yourself from demand-backed expectations and make what I call uncommitted assessments of the probabilities. Unlike the markets, in our everyday social lives we can and do exert control over the environment to assure ourselves of the outcomes that we desire. The rules we learn to abide by in order to interact with one another are our expectations about the future. Once we learn these rules, especially if we have learned them in a painful way, we can demand certain outcomes from the environment. Hence, our expectations of the future are actually demands that the environment conform to our expectations of it. Without really thinking about it, we will carry these same kinds of demands with us into the trading environment because of our natural resistance to letting go of our expectations. That is, staying committed to any limited belief about the possibilities that exist in the markets is virtually the same as making a demand. If you have any doubts about this, consider that if we weren't demanding that the market conform to our expectations, then we would never have a reason to get angry when it doesn't. Have you ever gotten angry at the market? Anger is a natural defense mechanism. When we feel anger, it is an indication that the environment is assaulting us in some way, creating an imbalance between the mental and outer environments. The outer environment is either showing us something about itself or ourselves that we don't want to accept. We protect ourselves with our anger to ward off this assault. In our everyday lives, our anger can be an effective tool to get what we want, change what the outer environment is showing us about itself that we can't accept, or to ward off what the environment is showing us about ourselves that we can't accept. However, if we interact with the market with demand-backed or committed expectations of its behavior, we will cut ourselves off from the information that we need to make accurate assessments of its potential to move in any given direction. If we don't have the power to control the markets in such a way as to make them do what we expect them to do, and at the same time we aren't willing to give up our expectations and accept the way things are, then it would create what would otherwise be an irreconcilable dilemma if it weren't for our ability to distort, alter, or exclude information from our awareness. Perceptual distortion is the one compensating factor that will, at least temporarily, correct the imbalance between what we expect and what the market is offering. When there is a difference between the two, our committed expectations about the future will act as a force on our perception of market information to control its flow into our mental system in such a way as to avoid a confrontation with anything that doesn't conform with what we already believe is possible. Which, of course, is always going to be less than what is possible from the market's perspective. If we are perceiving much less than what is available, then we are out of touch with what is possible from the market's perspective and setting ourselves up for a painful forced awareness. To be objective, you have to make uncommitted assessments of the probabilities, which simply means that you have no commitment to any particular outcome. You just observe what is happening in each moment as an indication of what will probably happen next. Here is what objectivity feels like, so that you can recognize when you have achieved it. You feel no pressure to do anything. You have no feeling of fear. You feel no sense of rejection. There is no right or wrong. You recognize that this is what the market is telling me, this is what I do. You can observe the market from the perspective as if you were not in a position, even when you are. You are not focused on money but on the structure of the market. To stay objective, anticipate as many possibilities as you can and how probable each of these possibilities are. Then decide in advance what you are going to do in each situation. If none of your scenarios is working out as you anticipated, then get out. Release yourself from the need to be right. The more uncommitted your assessments are, the less potential for distortion and experiencing a painful forced awareness. Step 7. Learning to monitor yourself. As outlined in the exercise to develop self-discipline in Chapter 14, you need to start paying attention to what you are thinking about and what market information you are focused on. Trading rules. When you are in a trade, constantly ask yourself if anything has to happen. Obviously, you want the market to go in your direction. However, what I want you to do is monitor how you feel, your level of commitment to what has to happen. Remember, there is a big difference in perspective between what is happening and something that has to happen. If you find that your commitment levels are rising, keep on telling yourself that it is all right for anything to happen because you are confident in your ability to respond appropriately to whatever does happen. Ask yourself, what can't happen? What can't the market do? When you find yourself rationalizing the market's behavior to support your position, you are operating in the realm of illusion and setting yourself up for a painful forced awareness. Remember, the market can do anything, even take your profits away if you allow it. Always take something out of the markets when you find yourself in a winning trade. A question to ask yourself is if you are prepared to give yourself money today. If the answer doesn't come back a resounding yes, then find out why before you trade. If you can't reconcile the issue or set it aside, then you would be better off not trading, until you do. If you are determined to trade anyway, at the very least make a substantial reduction in the number of contracts you normally trade. When you find yourself focused on the monetary value of a trade instead of the structure of the market, i.e., what the trade is worth to you in dollar terms, dreams, goals, and so forth, instead of what the market is telling you about its potential to move in any given direction, Then assume you are distorting or avoiding certain information and either don't put the trade on or take what you have off until you become more objective. Chapter 17. Final note. Even after you have learned all of the skills set forth in this book, at some point in time it will probably occur to you that your trading is simply a feedback mechanism to tell you how much you like yourself in any given moment. After you have learned to trust yourself to always act in your best interests, the only thing that will hold you back is your degree of self-valuation. That is, you will give yourself an amount of money that directly corresponds with what you believe you deserve based on some value system you acquired at some point in your life. The more positive you feel about yourself, the more abundance that will naturally flow your way as a byproduct of these positive feelings. So, in essence, to give yourself more money as a trader, you need to identify, change or decharge anything in your mental environment that doesn't contribute to the highest degree of self-valuation that is possible. What's possible? Stay focused on what you need to learn, do the work that is necessary, and your belief in what is possible will naturally expand as a function of your willingness to adapt.